Taxes, taxes, taxes. All anyone ever wants to know about is taxes, which, all right, fair enough, I can't blame them. So let's tackle a common concern people have when initially setting up a living trust. Does your living trust need to file a tax return? Right off the bat, let's tank this video in the YouTube algorithm and just answer the question. No, your revocable living trust does not have to file a tax return. Yet. And let's explore why. Really quick, I would greatly appreciate a like and subscription for you if you haven't done so already. Also, don't forget to share the video with that special someone you're trying to convince to finally create a trust. And without further ado, let's dive in. To first know whether a trust needs to file a tax return, we generally will need to know whether it's a revocable or irrevocable trust. Of course, there are going to be exceptions to the guiding principles I'm about to discuss, but it will hold true for the vast majority of cases. If a trust is revocable, meaning it can be amended by the trustor or settlor, as well as revoked entirely, then generally no tax return. Yet, which is a point we'll come back to. If a trust is irrevocable, meaning no changes can be made to it and it cannot be revoked, then that irrevocable trust will need to file a tax return. Maybe. It depends. I know, we'll get there, but we need to first discuss the revocable living trust, as that discussion leads us directly into the irrevocable trust discussion. A revocable living trust is a trust that, while it does have terms, any of those terms can be changed by the trustor or settlor. Same thing here. And that can be done at any point in time, and it can be revoked entirely. In this type of trust, you are typically the trustor, trustee, and initial beneficiary, or at least trustor and beneficiary, and therefore the trust ID number, or EIN, the number you file tax returns under, is just your social security number. Due to this fact, there's no separate return to file. There's not even a separate schedule to include with your normal tax return. It's you. It's still your stuff, so you just use your normal tax return. Now, after your death only, not your incapacity, the situation changes. We cannot report activity on your last tax return when it occurs after your date of death. All that activity is therefore attributable to your estate, which, if you have a trust, means to your trust estate. Additionally, your trust at this point is irrevocable, since only you could amend or revoke it, and your trust continues on after your lifetime. Think about it this way. The trust and you are one, but at death, the trust springs forth beyond you and continues living. It has assets, and the trust says what to do with those assets before closing down at some later date. However, remember, we cannot use your social. As a result of all this, the trust will need its own social security number, which will be the TIN, EIN, trust ID number, federal tax ID number, whatever the company wants to call it. It is at this point that your trust will likely have to file a return, but maybe not. It depends. Which, on that note, let's talk irrevocable trusts. Irrevocable trusts are separate entities from you, like a corporation or an LLC. Think of it as a whole new person. Due to this, it will typically file its own return unless there's a reason why it doesn't have to, which is typically either because the trust is either empty or there's little to no economic activity to report, as in there's just not enough income or there hasn't been an event that requires a return even if no tax is owed. First, let's talk about empty trusts. An empty trust is one that has no assets in it. One of the requirements of a trust is that it contains assets. Therefore, when a trust is empty, it's otherwise invalid or ineffective. But why would you have an empty trust in the first place? A trust could be empty because its assets have either been sold, distributed, or maybe have gone up in smoke. Another common example of why a trust may be empty is because it's yet to be funded. No assets have been transferred into it yet. An example of this action is where we have a special needs trust as the beneficiary of a revocable living trust. That special needs trust is irrevocable by design, and it's created to provide for the care of another, but only to do so, or only get funded, after your death. Typically because the special needs trust is the beneficiary of your revocable living trust. I've talked about special needs trusts at length, including the various use cases and functions, so we won't go down that tangent here. I'll link to a video in the corner as well as the description if you want to learn more. The second example of where an irrevocable trust would not have to file a tax return is where there's just not enough economic or financial activity in that trust to require the return to be filed. However, to better understand this point, I think it would be best to reframe it and understand when an irrevocable trust would file a return. An irrevocable trust must file a return where it either has a gross income of $600 or more, or where the trust has any taxable income whatsoever. And you can find this in the Internal Revenue Code section 6012A4. All right, I know you just heard that and are now thinking, just what the heck is the difference between gross income and taxable income? Well, don't worry, I'll make it easy to understand. Gross income just refers to all the income a trust receives from any source anywhere. If the trust gets paid $1,000 from the rent of 2 properties, then the trust's gross income is $2,000. Taxable income, however, refers to essentially the trust's net income. To determine a trust's taxable income, you first calculate the gross, take our $2,000 example, and then subtract any deductions, exemptions, and losses. Let's say we have $250 in deductions, no exemptions, but we have $500 in losses. In that case, we subtract $250 and $500, or $750 total, from our $2,000 gross income and find that we have a taxable income of $1,250. Thus, if an irrevocable trust has over $600 in income before we account for the deductions, exemptions, and losses, then the trust will need to file a return. Additionally, even if the trust had less than $600 in gross income, if after taking into account deductions, exemptions, and losses, we still have a positive number, then we have a tax return to file. As a bonus fact, if any of the beneficiaries of a trust are a non-resident alien, then IRC 6012A4 also requires us to file a tax return no matter the trust's income. I also mentioned a case where even if we have activity to report but not necessarily a tax to be paid, we still have to file a return. An example of that is where the trust maybe holds a piece of real estate and sells the real estate, but doesn't owe any capital gains tax on that. Even if the trust tax burden is $0, the trust sold a piece of property, so it still has to file a tax return even if that return says $0 is owed in taxes. Lastly, since we're on the topic of trust taxes, let's briefly go over the tax brackets for trusts in 2024. Because yes, just like your personal taxes, trusts are taxed in brackets at different rates for each income threshold. For the 2024 tax year, the first $3,100 of trust income is taxed at 10%. The next batch of income up to $11,150 is taxed at 24%. The next batch up to $15,200 taxed at 35%, and any income above that $15,200 is taxed at the maximum rate, 37%. Here's an example of how this would play out of a trust with taxable income with $20,000. As you can see, after working through each bracket, a trust with taxable income of $20,000 will pay $5,435.50 in taxes, which equals to an effective tax rate of 27.18%. Bringing it all back together, no, your revocable living trust does not have to file a tax return while you're alive, because from a tax standpoint, the trust is still you, so you file your tax return as normal. However, after you pass away, your successor trustee will likely have to file a tax return for the trust as a part of the trust administration process. This is because the trust would then be an irrevocable trust and thus a separate entity from you and your personal estate. There are also trusts that are irrevocable by design, and unless they are empty or really have no taxable income to speak of, then that trust will need to file a tax return as well. This was only scratching the surface of trust taxes and tax returns. Let me know if you have any questions in the comments below. Were you aware when a trust needs to file a tax return? Thank you for watching. Don't forget to like, subscribe, and share the video with your trustee. I'm Attorney Andrew Bethel, and I'll see you at our next meeting.